So we're talking about the liability management at commercial banks, and I have, uh, our favorite two largest banks in the U.S., J.P. Morgan Chase and Bank of America balance sheets pulled up, but I also pulled up the Federal Reserve asset and liability of commercial banks up until the August of 2023. In fact, I have it all the way up to September 27th. As we discussed in class, bank information is publicly available and it's actually quite regularly updated with very, very high frequency. One of the things about econ people is that their data is usually monthly, and anything when you talk about GDP or more macroeconomic indicators, you're talking about quarterly and sometimes even annually, and they always get amended and they always get updates. And when it comes to finance, we have data that comes in instantaneously. So, and banking data, because it has such a vital role on the economic health of a country, of the world. This information is regularly updated. So, and it's publicly available. So on this table, you'll see that in the yesterday's or Wednesday's lecture, we talked about the asset management, and notice how these are all billions of dollars. So you're talking about as of August of last year, $17 trillion of bank credit, and notice how that amount is quite steady. It's actually increasing a little bit, but it is quite steady all the way through last month. And then when you look at, say, securities, and notice that's also pretty steady. So the banking asset structure usually does not change all that much. Banks maintain, and they do work very hard to maintain such regularity in their financial uh, standing. And asset management or asset liability management is their core business. And there is a nuance to it, obviously, given the changes in economic activity, and you can actually see those changes, but they're not going to be as big. Like, for instance, if you go before 2007, you would actually find that the mortgage-backed securities were a lot more prominent within the asset structure of banks, whereas nowadays it's 160 $16 billion for the entire banking system. So it's almost non-existent. Um, but let's look at our liabilities. From a bank perspective, the liabilities are the deposits. And obviously, just as any other institution, we can borrow. But from a bank's perspective, the cheapest money you can raise is the deposits. Well, we discussed this in class. Deposits are expensive. You have to have a branch network. Branches are costly. You have to hire people, pay insurance. The structures, lease, heating, cooling, security, all of that is costly. So sometimes banks or some type of banks do not opt for a wide branch network. We talked about how Bank of America does not have a branch in Louisiana. So, up until a few years ago, a few decades ago, Chase didn't have a single branch in Louisiana. They acquired Bank One, and along with it came the branches in Louisiana. And same thing with the Pacific, the West Coast, where, when Chase acquired VAMU, or Chase was made to acquire VAMU, all of a sudden they acquired all their branches. So the branch network is costly. And some banks usually uh, may not have as extensive branches, and some banks may not have branches at all. So what they would do is their liability structure would be more to borrow. So when we're talking about the traditional commercial bank, you have the deposits, you have the credits, and that's the usual mom and pop, local commercial bank. And when we look at, say, now the national side, JP Morgan Chase with Bank of America, you have that traditional commercial bank sense. However, again, um, banks can specialize. They can actually go into, say, HSBC in the US. They now specialize into more of a wealth management, high net worth individual retail. Well, not really retail anymore, but high net worth individual banking. And therefore, they try to lower the cost of deposits by focusing on, higher amount per client basis. And they don't really have any branches. They try to have all their activity online. And sometimes you will find banks who will specialize on credits only. Their branches will be more about mortgages, about business loans, and it won't be possible to open an account with them. No checking, no credit cards, no savings. Even if you were to be offered, it just may not mean much, or they may not offer services that you're looking for. And then on the other hand, you might actually find banks who are really into deposit raising, yet they're not really good at credits. So in this case, you would actually have banks swapping what they have. So that's what we see with respect to the borrowings. The banks can actually borrow from each other, or they can also borrow through preferred stocks or borrow through bond issuance. So let's take a look. First of all, going back to last year, we had about an $18 trillion, which notice how big JP Morgan Chase and Bank of America is. The entire system has $18 trillion. And about seven of those $1 trillion belongs to Bank of America or JP Morgan Chase. So we went from $18 trillion down to 17.3. And notice how this was, done towards just the past few months, actually, if you think about it. So, that's not really that big of a problem, but it actually shows a tendency in the market, in the overall economy, that if the deposits shrink, then the credit portfolio of these banks will also shrink, and they will actually slow down the economy. That's usually how the money creation system is slowed down, and you can actually see the effect of increased interest rates on the shrinkage of deposits. Then you see large time deposits, and these are, we talked about the CDs or time deposits, and notice they're like 1/10 of all the other total deposits, um, and then you're looking at the borrowings, and notice again, this is very much like the CDs, about 1/10 of overall deposits, and these have to be, increasing for the past year simply because interest rates are raising, and the banks have to make up that difference in deposits somehow. So if they have gone down about, 0.7 trillion, they need to actually make that up 0.7 trillion through their borrowings. They can't, because we talked about the asset management index. You have a maturity mismatch between your deposits and your credits, and there's nothing you can do about it. It just it's the nature of the beast. Your deposits will always be short term, even if it says large time deposit. Look how small that is, and therefore as a bank, you need to somehow maintain a safe liquidity management and asset liability management, while the integral part of this system is the maturity mismatch. And it seems to be working. We have checks and balances where you have the FDIC, and then you have your reserve requirements, and then you have your economic help from the Federal Reserve, and then you have your the last lender of last resort Federal Reserve window, and through that you maintain. But that's why once the system maintains itself, banks try to keep the exact same structure going forward year after year, and they spend tremendous amount of effort and financial resources to maintain such regularity. So we do have a little bit of the foreign effect on this, but as you can see how little that is. and also trading liabilities. Some banks seem to be into this, but again, it's nothing compared to any other deposit. So when we are talking about a liability management for banks, we literally are talking about mainly the deposits, and then on a very small fraction, large time deposits. And we talked about how CDs are not actually accounts, but they're securities. They're traded by banks and retail investors. And then we're talking again very small scale borrowings. I mentioned how preferred stocks can be a way for financial institutions to borrow. Just as a side note, preferred stocks are actually, um, in a way, actually uh, feel like a bond, and they don't. They float like the stock. In fact, they float along with the stocks on the floor, trading floor, and therefore, usually the only reason that people buy the preferred stocks is because they offer a good return, a coupon. And if the preferred stock stops paying a coupon, then it would have no value. And knowing this, only the reputable issuers can actually sell, um, preferred stocks at good value. And therefore, you would actually see larger banks like JP Morgan Chase, Bank of America, Barclays seems to be really into it. Deutsche Bank seems to be really into it. And but even so, their traded liabilities are very small. So you are looking at, when we talk about liability management again, you're primarily looking at the management deposits. And this becomes a management of liquidity, management of the maturity and management of branch network, and also management of reserves. So let's take a look at how JP Morgan Chase and Bank of America are structured with respect to their liability. So, I went to Yahoo Finance and pulled up JP Morgan Chase and went to financials and then clicked on balance sheet. And then and notice how on asset management, we talked about how their assets are structured. And then notice how their total capitalization is actually quite nice. You have about $715 billion total capitalization for an asset structure of about $3.7 trillion. So um, that's about fivefold approximately. So when you look at the total liabilities, notice how this is a little bit more, a little bit different than what we see for the entire market. Notice how the total deposits were 18, and then large time deposits and borrowings, and then trading, they were just minute, differences. Yet when it comes to JP Morgan Chase, of the $3.3 trillion of total liabilities, their total deposits are $2.3 trillion. So we have approximately $1 trillion of actual non-deposits, right? So that's interesting when it comes to JP Morgan Chase. So what could that be? So first of all, we have payables and accrued expenses, so primarily payables. That's about $351 billion. These payables can be, any deposit that's already been promised to pay out. It could be credit payments that the bank needs to pay out. It could be any sort of payment promise that the bank actually made, and that's extending above and beyond the fiscal period for this financial statement. So, and then you can look at the trading liabilities. That's very similar to the overall economy. It's actually very small, except they actually seem to have a little bit more long-term debt, and that's like approximately $422 billion. So a little bit more than 10% that we're used to. So when we compare to the others, I guess when you add the payables and the long-term debt, that's kind of make it into the $700 billion level. And therefore, with the other little bitty ones, with the trading liabilities and the other liabilities, that makes it approximately $800 billion. And all in all, we have about $2.3 trillion of deposits. and the rest of it, about $1 trillion, in either long-term debt or payments. Let's see if we have this similar structure for Bank of America. And yes, we do. And again, this is interesting because notice how of the $2.7 trillion of total liabilities, about 2 trillion of it is in deposits, and then the other 700 billion is um, payables. Trading liability is very small, but we actually have long-term debt and capital, very similar to a long-term debt. So very similar to JP Morgan Chase, we have significant long-term debt. I guess a little bit more than the overall market. So this makes it interesting in the case of larger banks, two of the largest banks in the US. So what are the risks that involve with the liability management for commercial banks? I've always talked about the maturity mismatch between the assets that we pay out and then how much liabilities that we have, the deposits, and how their maturities mismatch. But let's take a look and compare with respect to the reality of the situation, right? So when you look at the bank credit, I mean, again, I'm on the Federal Reserve, and we are looking at the asset and liabilities of commercial banks in the United States. And I'm looking at the August 2022, and notice how we have, real estate loans, residential real estate loans. I mean, these are all long-term loans. And notice how out of the overall, you know, the asset management of these banks, the bank credit of about $17 trillion. As you go through, shorter term treasury and agency securities, they are substantial. But then loans and leases and bank credit, these are a little bit longer term. You actually have substantially more. And then real estate loans are also significantly more. And then you go into the consumer loans, like the credit card and other revolving funds, other consumer loans. These are a little shorter term, and notice how they're not as much. And compared to the other longer term loans, you're actually as a bank, you're financing all of this with the very short term uh, deposits that you collect. So that is the main risk. Now, for some banks, especially outside of the US, there's always the management of the foreign exchange risk. People prefer to invest their money. People may prefer to invest their money in currencies such as US dollars or euros, or even other currencies, but the currencies that they find to be more stable. And on the other hand, they want to be able to borrow in their own native local currency. This puts the banks at a significant foreign exchange risk simply because their deposits, their liability is in US dollars or in euros. It's a foreign currency for them, and that their assets are all in local currency. So anytime a country's currency devalues, the banks are at a significant risk simply because their liabilities are all in US dollars, which is now gaining in value. And then their assets are all in local currency, which is now losing value. And from a bank perspective, commercial bank perspective, they're now at a significant risk. So in the US, we don't really have as much foreign exposure or foreign currency exposure, which is a blessing. However, the liability management of a commercial bank in the general sense also involves not just the maturity mismatch, but also a currency mismatch. And we also have a risk of the actual assets. Remember, we are financing all of these with our deposits. And even for, the default risk, even for the real estate loans that we are giving out, the house perhaps is the collateral, or for secured, loans that we give out, there's always some sort of a collateral or a securitization for it. For cars, the car has a lien on it, the title has a lien on it, consumer loans, and pretty much every loan that we give out, there's some sort of a collateral with it. However, that takes time to collect. I mean, if a mortgage goes bad, then the bank has to repossess and then sell the house, and that takes time. And the banks may incur losses. However, when it comes to the liability management, there is no such thing. You cannot just tell your deposit holders that their money is at risk, that you've given out their money as a mortgage and now you cannot pay that back. If somebody has a checking account, they're expecting you to pay it. I mean, think about it. If you go to Walmart and you want to use your debit card and the bank doesn't have the money, it can't happen. And therefore, we now have, three risks that involves for the liability management: the maturity mismatch, and then the currency mismatch, and obviously the level of risk mismatch. With the deposits, you can't risk. I mean, you kind of have to, but with the deposits, you need to be able to meet all the demand on the deposits, whereas you actually use those liabilities and then give them out as credits, and you may not be able to get everything back. So these three usually make up the main structure of our liability management. And so, when we are talking about the four quadrants of bank management, we talked about the liquidity management and the asset management, and now we're concluding our discussion about the liability management. And the last pillar is the capital adequacy. But they all tie in together, especially when we're talking about the liability management. Liquidity is a significant part of it. We simply cannot give out the entire liability structure into our assets, meaning we cannot use all our deposits and pay them out as credits. I wish we could, because we could actually make a whole lot of money. So perhaps we could include a fourth dimension to our liability management, and that's the profitability. We always talked about how the banks has to maintain their safety and their financial integrity, and we rarely talk about the profitability, but the banks have to use their liabilities and to generate a profit, because those liabilities have a cost. Even a checking account or a savings account may not actually have a payout, but you maintain the branch network, you maintain a cost structure to have those deposits, and therefore you need to earn profit on those liability structure. And therefore, while you're having all these risks, the fourth dimension may not be a risk, but unless you make a profit as a bank, you cannot exist. So, people may not include profitability into the liability management risk structure, but profitability is the essence of banks' existence. And therefore, if you cannot make profits out of your liabilities, then there's no point of having the liabilities. So, when we talk about the capital adequacy or integrity into the four pillars of banking, we'll discuss how, you know, or why a bank needs to, set aside that much capitalization for about $3.6 trillion of assets. Why is it that the banks need to be so highly capitalized? And why do they need to maintain such capitalization? And it ties directly into the liability management, because you're not, as a bank, allowed to dip into your deposits. Meaning, while you can give out credits and you can actually enjoy the ability to direct or route the money in any way you seem fit. However, you're not allowed to lose the deposits on bad loans, and you have to come up with the money to make up any banking failures that are due to your inability to maintain safe credits. And therefore the capitalization comes in there. And the liability management, goes hand in hand again with the liquidity, where you have to keep the liquidity, and with the asset management, where you have to make sure that your losses do not dip into your deposits, and your capitalization, where if you have losses, your capitalization can cover it. And if you fail to cover it, then you lose your license. And then the FDIC knocks on the door and you leave the key. So, having said that, I think for the liability, I'm going to wrap it up for today, and I'll have the video for the capital adequacy and integrity, for today. So, thank you for working with me. I really appreciate your understanding. And if you have any questions, please do ask. And I'm always available for a Zoom meet. And just let me know. Thank you so much, and have a great night.